Hi everyone, so welcome to the Introduction to Investments course. So I am Vinny Onofre by Compound Improvements, and I will take you through the Financial Education and the Basics 1 module. So I think, first of all, you and I know that the first thing you need is a financial aspiration, right? Because if you don't have a financial dream, if you don't know what you're aiming for, you never get there. So what is it like to be rich for you? Is it time that you want to spend more with your family? Is it the freedom to travel and to work with people who you love? Is it the intensity of life to live life in the full flavor, or is it just getting the best that life has to offer? So the first step is, how much do I want? Why do I want? Most people, they have the dream of achieving their first million, and it's a very important milestone. So we are going to think about this first million, either to buy a car, to buy a house, to buy a beach house, whatever it is. And this is a very interesting topic, because the dream 40 years ago was to have a new phone, brand new house, brand new car. But today's dream is quite different. It's to have private school, private health, private pension. So let's think about, why do you want to be financially free? That's the first step. So right after this exercise, the number one homework out of here is to identify on why you want to get wealthy, and then have the conversation with your partner, if you have one, on what's your objective to get there and how you're going to get there. So let's think about a private pension. So let's say that you currently have $8,000. And so you're in a position that you start saving every month, and let's say that you can save 500 every month, for 300 months. So that is quite a long time. So let's say you have that 300 months. That's about 25 years. And then let's say that every single month you have the ability to put $3,000 into that saving scheme, into that pension plan. And let's say that the monthly interest rate is 1%, but you know that the expected inflation rate is about 0.32%. So the real monthly interest you're getting is 0.68%. And that is very important, because that's how it happens. You have the nominal rate on the left-hand side minus the inflation, which is the cost of money, equals the real monthly interest. Because let's say here I'm in the UK, so this year I did my returns on my investments were 10%. Does it mean that my money now is worth 10% more? Not really. It's 10% minus the inflation rate of the UK in the year of 2020, which is about 2%, equals a real return rate of 8%. So my money now is actually worth 8% more than last year. So that is very important, because inflation will always be there. Remember, taxes and inflations will always be there, and they need to be taken into consideration. Okay, so what are actually things that are holding you back? So I think everyone knows this. You and I know that credit interest to pay every year up to 150% a year is way too much. That's the first thing that you need to eliminate, is credit card fees. But even greater threat is, what's the underlying condition that is making you spend more than you earn? Is this anxiety? Is this uncontrollable desire to keep your consumption up every single time? What are the driving costs, and how you can make changes that make a difference? So the Pareto principle says that 20% of the activities that you do produce 80% of the results. And that's where we need to focus on. We need to focus on the biggest expenses that we can. So what are those? We need to first identify what's a wish versus a need, right? So a need is something that I must have. I must have somewhere to stay and to sleep. I must have food. I must have transportation to my work. So all those things are needs. But wishes, how many clothes you have in your closet that maybe you wore once and then you threw it in the back of the closet and never wore again? How much money would have you saved? And then if you had put that money that you wasted on clothing to let's say an index fund, and returning you 7% per year, you would have doubled that money in 10 years, you know? And those are simple changes that make all the difference. So the first step is when you sit down and do your homework to determine what's really essential, right? So let's take the example of a beach house. How often will you use it? When the weather is not appropriate, we will rent it out, or we will just leave it there empty. And be aware of things like crisis, depreciation. So, for instance, with COVID-19 now, that's a big time that you won't be renting out, you won't be using that house for over a year. So, and those are things that we usually don't think about when doing purchases. So the first step to invest is you must be aligned with your finances so that you can start going from saving to investing, and that is really important. So let's go through the family budget. So how is your money doing? The first step is to map out all of your monthly costs. Second step is to determine your long-term lifestyle target. And then third step, last but not least, is to set up short-term goals so you can feel the victory every single time that you achieve your goals. So let's go through this. So here's a little table example of how you can register all of your incoming streams, right? So you have the net salary of the husband, net salary of the wife, the received bonus, the income tax devolutions, other incomes. And, I actually think that people should focus more on how they can earn more than how they can save more. And the reason for that is because you can always earn more, There's so many ways that you can earn more. There is a blog post of mine, 15 ways to supplement your income in the share economy. You can become, let's say you have your 9 to 5 job. Okay, what do you do from, let's say, from 6 to 10? You could be doing Uber driving, you could create your own blog, you could do your own course on what you're passionate about. What are the things that you research and that you have expertise on and that other people will appreciate? Or you could, delivery, you could do so many things. And you may say, it doesn't pay well enough, but if you do it enough, it will pay more. But after you maximize your income streams, then you move on to write down all of your fixed and variable expenses. And fixed expenses are very straightforward. So things that are you're going to be paying no matter what. So rent, transport, probably the essential food, that is very hard to get rid of. So in those fixed expenses, what you need to do is to focus on how you can maybe downgrade them. So let's say if you live in a 3-bedroom flat, but just you, your husband, and a child, maybe you should consider downscaling to a 2-bedroom flat or a 1-bedroom flat. But that is very hard to cut those fixed expenses. But if you manage to do it, you're gonna produce the greatest results. And then after that, you can move to the variable expenses, which is the little things in life that by themselves they don't make much difference, but as a congregate, they can actually support your financial aspirations. Other spending and contingencies, you always need to save money for a rainy day, no matter what, because the worst thing that can happen is that you have investment in stocks, which that in the long term they're going to produce very excellent results. But if you're forced to liquidate those investments in the short term in order to pay for emergencies, you're doomed. So therefore, you must have cash for a rainy day. And a good position that they put in business for a company or also for an individual is you have cash for a rainy day for about 6 months of your fixed expenses. That's a rule of thumb. So, which brings me to the last point, which is, the cardinal thing is to spend more than you earn. So you must not do that. So your income needs to be at least 20% higher than your spend. Which brings me to the next point, which is the family budget. So I'm gonna share this tool with you. So all you have to do is populate this. So that is the total work revenue for the family income, the retirement if you're retired, the fixed revenue, and then therefore the total income. And then the main expenses by month. So fixed expenses first. So rent, electricity bill, water bill, gas bill, phone, internet bill, cable TV bill, public transportation, and then move on to the variable expenses afterwards. So public transportation, insurance, financing, health, food, education, credit card bill, investments and savings, and secondary expenses such as gifts, entertainment, leisure, clothing, beauty spendings, book CDs, DVDs, um, emergencies, everyday spendings. Then you're going to get the total expenses, the monthly balance, which consists of total income minus total expenses, and finally the net position for your month. I think a couple of points here. So bills, you can always negotiate your bill. You can call your provider, and trust me, I've done this 100 times. You can call your provider and say, "Hi, would you say that I'm a loyal customer?" Yes. How long have I been a customer with you? Oh, 3 years. Would you say that I am valuable to your business? Yes. Unfortunately, I'm not in the position to pay the same amount as I've been paying for the last 3 years. So I would like to know what are other options to finance my electricity bill or my water bill or my gas bill. And I assure you that this will bring you some reductions, especially in times of distress such as COVID-19, where people lost jobs, where people got their salary frozen, where people got furloughed by the government. So take crisis as an opportunity for you. And then the second thing here that I want to talk about is the investment savings. Instead of starting the spreadsheet from your fixed expenses, start from your investment savings. Put at least 10% down here. And then you can do fixed expenses here in the main expenses, and then after that, whatever is left, you can then move on to the secondary expenses. Okay, now that we're done with family budget, let's discuss interest rates, because now we've gone through how you can save more so that you can start investing. And a lot of people, they think that you need a lot of money to start investing, but not really. You need $50. That's it. That's how much you need to start investing, And the most important thing about investment is understanding interest rates. So what is it? Basically, is the cost related to borrowing money. So let's say I want to start a lemonade stand down the road, but I don't have capital. So why would someone lend me capital so they can start my lemonade stand? Well, they're taking a risk on that money because they don't know whether I'm going to be able to pay them back. So therefore, they charge me the interest rate of that money, which is the risk premium for the fact that they are lending me that money. So, but have you ever thought about how much interest you pay? Because there are a lot of things in life that you're paying interest, but you even don't know about it. So the obvious ones are mortgage, credit card bills, but there is also like bank fees. Let's say uh, your phone bill. If you buy, for instance, your phone via Vodafone or AT&T and pay on a monthly basis rather than one-off, you're probably paying interest there too. So let's say that you have a negative balance of $7,000, which is a pretty hefty one. But let's say that in your first payment, you're supposed to put down the first month $210. But out of the $210, only $140 is actually being spent to the amortization of your debt. That is called the principal. So therefore, you're going from $7,000 to $6,860. And so where did the other amount go? So where did the other $70 went? So it went to the interest part. So you're paying the interest to the bank or to the provider. Um, it doesn't sound that much in the month one, but know that every single month you're paying that interest. Obviously, it's going down because the debt is going down because you're paying the amortization rate here. But all in all, if you multiply that by how much it's gonna take to pay this whole debt, that will mean that half of the debt you're gonna be paying as interest on top of the principal of that debt. So if you can, do not get into this kind of debt. Always pay your credit card fees in full rather than the minimum amount. That's the only way to get rid of this. And then if you are in the position that you cannot pay your negative balance, then you need to go through this. Number one, are you in a low budget? Pay your interest debts, your high interest debts first. So figure out what are the ones that are charging you the highest interest rates and pay them first. Secondly, know every single debt that you have, and trust me, they will chase you. No matter if you even leave your country, if you're living from one country, from one EU country to the other, they're gonna chase you, and it's gonna get into your records. You don't want them. Number three, always negotiate with your bank. So banks, the worst case scenario for them is to receive nothing, but if they receive something, at least the principal on the debt, they will be happier than if they receive nothing. So there's always space for negotiation with your bank. This is something that most people are not comfortable with, but think about your family. Think about the fact that you want to get out of that rut situation. So you need to actually summon the courage to negotiate with your bank. And if you don't have that yet, start off small, so you can create the habit. Next time that you go and order a coffee, ask for a 10% discount. It's just that. Is being comfortable with the uncomfortable. I remember that I had a lot of fees from Barclays because they would charge me £8 every time that I had a standing payment but didn't have a balance in my account. I would call the bank and I would say, look, I would like a refund on this. There was 2 times that they told me no, and then I said, okay, I'm switching my bank then, or okay, I would like to speak with your manager then. And every single time they would end up, after a bit of conversation, they would end up waiving the fee. And then if they didn't, what I would do was shut the phone and then call the bank again, get with another customer advisor, and then get that refund. So, which leads me to the next point. Keep your feet on the ground. Stick to it, even if it's uncomfortable. Last but not least, there are situations that you cannot handle on your own. So seek advice from your family, friends, and if necessary, go after the business bureau or the citizen advice in your country. They will be able to help you. Now let's talk about the first point that I described, which is the highest interest rates bit. So let's say that you're in this position that you broke your credit card limit, you're into the overdraft, which is really a bad position to be in, let's be honest. But it's not impossible to get out of that. So let's say that you've got actually a fee with 3 different banks. With bank A that is charging you 8.76%, bank B 8.77%, and then bank C 31%. So which bank do you think that you should pay first? I'll let you some time to reply that question. 3, 2, 1. Well, obviously you need to pay first the bank C because it's the highest interest rate. And you may think that it's not that much, 2% per year. But look at how it racks up. The 10.31% per month will end up being at 224% per year. Per year. That basically means multiplying the money that you own by 3. Even if it's 0.01 percentage points of difference, the annual interest will be like 0.3%. It's considerable. And the reason for that is because this is not simple interest. This is not 1% plus 1% plus 1%. This is compound interest.